B2Gold has positioned itself as a significant mid-tier producer undergoing a transformation. As the company navigates the maturity of its legacy assets in Namibia and the Philippines, it is simultaneously commissioning a massive new project in the Canadian Arctic and renegotiating its foundational agreements in West Africa. This analysis provides an evaluation of the company's operational performance, financial health, strategic pipeline, and the multifaceted risks that define its investment profile in 2025. Operational resilience and the Fekola complex. The Fekola complex in Mali remains the cornerstone of B2Gold's production base, serving as a primary driver of cash flow and a testament to the company's ability to operate in high-risk jurisdictions. In the third quarter of 2025, the Fekola mine demonstrated exceptional operational elasticity, reporting a revenue surge of 142% year-on-year to reach $472.58 million. This performance was underpinned by an 88% increase in gold output, which allowed the company to capitalize on an average realized gold price of $3,440 per ounce, a 39% increase from the previous year. Such results illustrate the company's capacity to leverage high-grade ore bodies and efficient processing infrastructure to maximize returns during periods of commodity price strength.
The continued success at Fekola is not merely a function of market tailwinds, but a result of meticulous mine planning and execution. The company achieved a milestone of 4 million ounces of lifetime gold production at Fekola in 2025, reaching this mark in less than 8 years since construction completion. This throughput has been maintained by accessing higher-grade ore from the Phase 7 and Cardinal pits, a strategy enabled by a significant deferred stripping campaign conducted throughout 2024. By delaying the extraction of these high-grade sections to coincide with peak equipment availability and favorable market conditions, B2Gold has optimized the project's net present value. A critical pivot for the Fekola complex is the move into underground mining. B2Gold received formal approval from the state of Mali to commence underground operations in late July 2025, with production starting shortly thereafter. The underground segment has already outperformed initial expectations, with production guidance for 2025 revised upward to between 30,000 and 40,000 ounces. This underground expansion is vital for maintaining the mill's feed grade as the open-pit operations transition into deeper, more challenging zones. Furthermore, the integration of the Fekola regional deposits represents the next frontier for the complex. While regional gold production was null in 2025 due to timing delays in receiving the exploitation permit, mining is expected to commence in early 2026, with a projected output of 180,000 ounces per year over the first 5 years of production.
Geopolitical risk management and the Malian mining code. The primary shadow cast over B2Gold's Malian operations is the 2023 Mining Code and its subsequent implementing decrees. This legislation reflects a broader trend of resource nationalism across West Africa, where governments are seeking a greater share of the economic benefits derived from their mineral wealth. The new code increases the potential state and local interest in mining projects to a combined 35%, up from the previous 20%. Specifically, the Malian government now holds a 10% non-dilutable stake, with the option to purchase an additional 20% within the first 2 years of production, while an additional 5% can be ceded to local interests. Furthermore, the code implements a substantial increase in royalty rates, which have risen from 6.5% to 10%. For a high-margin producer like B2Gold, these fiscal adjustments represent a structural shift in the asset's cost profile. The implementing decree issued in July 2024 further amplified state control by imposing strict local content requirements and restricting companies to a maximum of 3 exploration permits per district to prevent monopolization. Any transfer or change of control in mining permits now requires multi-ministerial approval, reinforcing the state's oversight of private investment.
Despite these tightening regulations, B2Gold has maintained a productive relationship with the Malian authorities. In November 2025, the company confirmed that its operations at Fekola continue unimpeded and that all permits and licenses remain in good standing. The government's decision to approve the Fekola underground expansion and the advanced progress of the regional exploitation permit suggest a recognition of B2Gold's role as a critical contributor to national revenue. This ability to navigate political volatility while maintaining operational continuity
is a core competency of the B2Gold management team, which has historically succeeded in diverse and challenging environments such as Russia and Nicaragua. The Goose Mine, a new anchor in the Canadian Arctic. The acquisition of the Back River Gold District through the purchase of Sabina Gold and Silver in 2023 marked B2Gold's entry into Canada and represented a strategic move to balance its jurisdictional risk. The Goose Mine, the first development in this district, achieved commercial production on October 2, 2025. This achievement was a major milestone, particularly given the logistical complexities of building and operating a mine in the remote Kitikmeot region of Nunavut, where winter temperatures frequently drop to -30 degrees Celsius, and the site is not connected by road to any major infrastructure.
The path to commercial production at Goose involved a rigorous ramp-up phase. The company defined commercial production based on 30 consecutive days of mill throughput at or above 65% of the design capacity of 4,000 tons per day. During the measurement period from early September to early October 2025, the mill achieved an average throughput of 2,652 tons per day, or approximately 66% of capacity. By late September, performance had improved significantly, with the mill reaching 81.2% of design capacity as the operational team dialed in the grinding and crushing circuits. However, the commissioning process was not without hurdles. B2Gold was forced to revise its 2025 production guidance for the Goose Mine downward between 80,000 and 110,000 ounces, compared to the original forecast of 120,000 to 150,000 ounces. This adjustment was primarily due to a capacity shortfall in the crushing plant during the third quarter. To mitigate this, the company deployed supplemental mobile crushing capacity to ensure a consistent feed of ore to the mill while permanent optimizations were being implemented. These optimizations include the installation of surge bin capacity and modifications to the secondary grinding circuits, which are expected to be finalized by late 2025.
Despite these early-stage bottlenecks, the long-term outlook for the Goose Mine is robust. The mine is expected to produce an average of 300,000 ounces of gold per year between 2026 and 2031. The economic profile is bolstered by high mill feed grades, which are expected to average between 6.5 and 7.0 grams per ton in the fourth quarter of 2025, and recovery rates exceeding 90%. Furthermore, the company is conducting optimization studies to evaluate increasing the mill throughput to 6,000 tons per day and implementing a flotation/concentrate leach process to further enhance recoveries. Managing mature assets, Namibia and the Philippines. While Fekola and Goose represent the growth and cash flow engines of the company, the Masbate mine in the Philippines and the Otjikoto mine in Namibia provide essential stability and diversification. The Masbate gold project has consistently exceeded expectations, with production guidance for 2025 increased to between 190,000 and 210,000 ounces due to strong mill throughput. However, the Masbate project must also contend with a new fiscal regime. The Enhanced Fiscal Regime for Large-Scale Metallic Mining Act, signed in September 2025, introduces a profit-based royalty system and a windfall profits tax ranging from 1% to 10%. The law also mandates ring fencing, which prevents companies from offsetting losses in one project against profits in another. While these changes increase the government's share of mineral wealth, the simplified and more transparent tax structure is designed to provide greater fiscal stability for long-term investors.
In Namibia, the Otjikoto mine is transitioning from open-pit mining to underground mining and stockpile processing. Open-pit operations are scheduled to conclude in late 2025, a natural progression that has led to a workforce reduction from 700 to 400 permanent employees. To extend the mine's life and maintain its production profile, B2Gold is developing the Antelope underground deposit, located just 4 kilometers from the existing pit. A development decision for Antelope was approved in September 2025, with an optimized pre-production capital cost of $105 million. The integration of Antelope with existing low-grade stockpiles has the potential to sustain production at approximately 110,000 ounces per year through the early 2030s. Financial health and capital allocation. B2Gold's financial position in 2025 is characterized by strong liquidity and a disciplined approach to capital management. As of September 30, 2025, the company held $367 million in cash and cash equivalents, with an additional $650 million available under its revolving credit facility. This liquidity was significantly bolstered in early 2025 by the issuance of $460 million in 2.75% convertible senior unsecured notes due in 2030. The proceeds from this offering were initially used to pay down the revolving credit facility and fund working capital requirements for the Goose mine construction. The company's revenue performance has been robust, with third quarter 2025 gold revenue of $783 million, a 75% increase over the same period in 2024. This growth was driven by a combination of higher sales volumes and the dramatic rise in the gold price. Adjusted net income for the third quarter of 2025 was $180 million, or 14 cents per share, demonstrating the company's ability to convert high revenue into bottom-line earnings. Furthermore, the company's cash operating costs remain stable at $780 per ounce produced in the third quarter, a testament to its operational efficiency in an inflationary environment.
B2Gold's cash flow profile in 2025 is characterized by robust operating generation that is currently offset by the peak of a major capital investment cycle. For the 9 months ending September 30, 2025, the company generated $605.26 million in cash from operating activities. During the third quarter specifically, operating cash flow before working capital adjustments reached $180 million. This performance was heavily supported by the surge in gold prices, with the company achieving an average realized price of $3,133 per ounce across its operations in the third quarter, a 26% increase over the previous year. The company's free cash flow, FCF, has remained negative in the short term, with the last 12 months showing an FCF of approximately negative $248 million. This hump in the cash flow cycle is primarily due to the heavy capital intensity of the Goose mine construction and the expansion of the Fekola complex. Capital expenditures peaked in September 2025 at $902.7 million for the trailing 12-month period. However, as the Goose mine moves from commissioning into steady-state production and major capital projects at Fekola conclude, analysts project a significant turnaround, with free cash flow potentially rising to $1.86 billion by 2029.
To maintain liquidity during this transitional phase, B2Gold has utilized several strategic financing instruments. Convertible notes. In January 2025, the company issued $460 million in 2.75% convertible senior unsecured notes due in 2030 to fund working capital and general corporate purposes. Gold prepayment arrangement. The company entered into a $500 million gold prepayment arrangement in early 2024, which involves the delivery of gold ounces through June 2026. As of September 30, 2025, these obligations are classified as current liabilities, impacting working capital. Credit facility management. The company drew $200 million from its revolving credit facility, or RCF, in the third quarter of 2025 to manage the working capital requirements of the gold prepayment deliveries. On October 3, 2025, the company repaid $50 million of this balance, leaving $650 million available for future use. Shareholder returns remain a priority, with the company maintaining its quarterly dividend of 0.02 cents per share, or 0.08 annualized, which provides a yield of approximately 1.7%. This dividend is supported by a conservative payout ratio of roughly 22% of earnings.
Additionally, the company is active in its share buyback program, repurchasing 2 million shares for $10 million under its normal course issuer bid during the third quarter of 2025. Looking ahead to 2026, cash flow is expected to be significantly bolstered by the full contribution of the Goose mine, which is projected to produce 300,000 ounces of gold annually. Furthermore, the commencement of mining at Fekola Regional is expected to add another 180,000 ounces per year starting in early 2026. This additional high-margin production is anticipated to drive a substantial increase in cash inflows, marking the end of the current capital-intensive transition period. Valuation. B2Gold's valuation profile in late 2025 presents a stark contrast between its current trading multiples and its projected intrinsic value, reflecting both the market's caution regarding geopolitical risk and its anticipation of a major production pivot. As the company transitions from a period of heavy capital investment to a steady state of high-margin production, its valuation metrics are undergoing a significant recalibration. Relative valuation and multiples compression. On a trailing 12-month basis, B2Gold appears expensive relative to its peers.
The stock trades at a price-to-earnings ratio of approximately 28.5x to 31.2x. This is notably higher than the U.S. metals and mining industry average of 26.7x and the peer average of 16.8x for similar mid-tier producers. This elevated TTM multiple is largely a function of suppressed earnings during 2024 and early 2025, a result of high expansion costs at the Fekola complex and the multi-year build-out of the Goose mine.
However, forward-looking metrics suggest a compression of these multiples as new production comes online. Analyst estimates for 2026 place B2Gold's forward PE at approximately 6.24x to 6.33x. This represents a significant discount compared to the broader sector's forward PE median of 17.44x. Similarly, the company's forward enterprise value to EBITDA, EV/EBITDA, is estimated at 3.69x, which is roughly 60% lower than the sector median of 9.31x. This divergence indicates that the market has not yet fully priced in the earnings surge expected from the Goose mine's steady-state production of 300,000 ounces per year starting in 2026. Intrinsic valuation and the DCF gap. Discounted cash flow models based on future cash flow projections suggest that B2Gold is trading at a massive discount to its fundamental value. Using a two-stage free cash flow to equity approach, some models arrive at an intrinsic value as high as $44.26 per share. At a late 2025 trading price of approximately $4.80, this implies the stock is trading at an 85.5% discount to its fair value.
This valuation gap is primarily driven by the jurisdictional discount applied to the company's Malian assets. The Fekola complex represents over 50% of the company's operating net asset value, NAV, and the market continues to penalize the stock for the potential impacts of Mali's 2023 mining code and regional political instability. Investors remain wary of the government's ability to increase its non-dilutable stake to 35% and the upward adjustment of royalty rates to 10%. Nevertheless, B2Gold's ability to maintain full operational capacity and receive critical underground mining approvals in 2025 suggests that the actual impact on cash flow may be less severe than the current market discount implies. Peer comparison and analyst sentiment. When compared to other mid-tier and senior miners, B2Gold's valuation appears attractive for growth-oriented investors. For example, Alamos Gold trades at a PE of 29.9x and Agnico Eagle Mines trades at 25.2x. While B2Gold's current PE is in line with these premium-rated Canadian-focused miners, its forward earnings growth rate is significantly higher, projected to increase by over 230% in 2025 and an additional 43% in 2026. Valuation re-rating catalysts. The primary catalyst for a valuation re-rating is the successful ramp-up of the Goose mine. As Canada becomes a larger contributor to B2Gold's total production profile, targeting 300,000 ounces annually, the company's jurisdictional risk profile will balance out. If B2Gold can demonstrate consistent, low-cost production in the Arctic, the stock is likely to trade closer to the higher multiples of its North American-focused peers. Furthermore, the finalization of the Fekola Regional Exploitation Permit, expected to add 180,000 ounces of annual production starting in 2026, will provide additional high-margin cash flow to support the company's 1.7% dividend yield and ongoing share buyback programs.
Balance sheet analysis. B2Gold's balance sheet as of late 2025 reflects a conservative capital structure that has remained resilient despite the heavy financial requirements of commissioning the Goose mine and expanding the Fekola complex. The company maintains a strong net asset position, with total assets valued at approximately $5.7 billion against total liabilities of $2.3 billion. Capital structure and leverage. A defining characteristic of B2Gold's financial health is its low leverage compared to industry standards. As of September 3, 2025, the company reported a total debt-to-equity ratio of 17.4%, or 0.19, which is significantly below the mid-tier gold mining industry benchmark of 0.36. This conservative approach is further evidenced by an exceptionally high interest coverage ratio of 123.8x, indicating that the company's earnings before interest and taxes, EBIT, are more than sufficient to meet its debt obligations. Total shareholder equity remains robust at approximately $3.4 billion. Liquidity and working capital management. The company's liquidity position is anchored by $367 million in cash and short-term investments. While the current ratio is relatively tight at 1.03 and the quick ratio stands at 0.46, these figures are heavily influenced by the accounting treatment of specific financing arrangements. Specifically, the company's $500 million gold prepayment obligation, under which gold is delivered through mid-2026, is classified as a current liability, which has suppressed the working capital figure to $35 million as of the end of the third quarter of 2025.
To provide additional financial flexibility, B2Gold maintains an $800 million revolving credit facility, RCF. Following a $50 million repayment in early October 2025, the company has $650 million of undrawn capacity available to support the final stages of the Arctic ramp-up and other growth initiatives. Financing and debt maturity. The company's debt profile was strategically reshaped in early 2025 with the issuance of $460 million in 2.75% convertible senior unsecured notes due in 2030. These notes were issued at an initial conversion price of approximately $3.17 per share, a 35% premium at the time of offering, and the proceeds were used to pay down the RCF to reduce interest expenses while securing long-term capital. This issuance transitioned a significant portion of the company's debt from short-term bank credit to a longer-term, lower-coupon fixed obligation. Asset composition. B2Gold's asset base is dominated by $3.8 billion in physical assets, primarily representing its high-grade mining operations and processing infrastructure. Inventory levels are also significant at $598.5 million, reflecting the stockpiling strategies employed at the Fekola and Otjikoto mines to ensure consistent mill throughput during transitions in mining phases. As capital expenditures have peaked at $902.7 million for the trailing 12-month period ending September 2025, the balance sheet is expected to shift towards cash accumulation as the Goose mine begins contributing high-margin revenue in 2026.
Strategic growth and exploration upside. The Gramalote project in Colombia represents B2Gold's next major growth opportunity beyond the Fekola and Goose complexes. In July 2025, the company announced positive feasibility study results for a 100% owned, medium-scale project at Gramalote. The study outlines an average annual production of 177,000 ounces over a 13-year life of mine, with an initial 5-year production average of 227,000 ounces. The project's economics are highly attractive, with an after-tax net present value, NPV 5%, of $941 million, and an internal rate of return, IRR, of 22.4% at a gold price of $2,500 per ounce. At current spot prices of approximately $3,300 per ounce, the after-tax NPV increases to $1.716 billion, with an IRR of 33.5%. The project benefits from a low all-in sustaining cost estimate of $985 per ounce and favorable metallurgical characteristics, with gold recoveries reaching 95.7% through conventional milling and flotation. B2Gold is currently working on permit modifications to reflect the new project scale, a process anticipated to take 12 to 18 months. Given the extensive historical drilling and engineering work already completed, Gramalote is significantly de-risked and stands as a prime candidate for a development decision in the near future.
Exploration remains a core driver of organic growth for B2Gold, with a 2025 budget of $61 million. A significant portion of this is allocated to the Back River Gold District to follow up on drill-ready targets defined during the 2024 Regional Exploration Program. In Namibia, the company is investing $8.5 million in exploration around the Otjikoto land package, aiming to uncover additional mineral deposits that could extend the underground mine life beyond current estimates. Risk assessment. Investing in B2Gold Corp involves several major risk factors, ranging from jurisdictional and geopolitical volatility to the operational challenges inherent in large-scale Arctic mining and transitioning legacy assets. Geopolitical and jurisdictional risks. The most significant risk is B2Gold's high concentration of value in Mali, where the Fekola complex represents over 50% of the company's operating net asset value. The implementation of the 2023 Mining Code and its 2024 decree has fundamentally altered the fiscal landscape, increasing the potential non-dilutable state and local interest in mining projects to 35%, up from 20%, and raising royalty rates from 6.5% to 10%. Additionally, regional instability persists, with multiple militant forces active in the country, creating a background risk of potential takeover or operational shutdown, though such extremes are currently considered unlikely by analysts. Asset maturity and transition risks. B2Gold is managing a sensitive transition at its Otjikoto mine in Namibia as open-pit reserves are depleted. Open-pit operations are scheduled to end by late 2025, leading to a reduction of 300 jobs as the site shifts to processing stockpiles and underground mining. While the new Antelope underground deposit is expected to supplement production, failure to successfully integrate these underground grades could result in a sharper-than-expected production decline in Namibia. Regulatory and fiscal risks. In the Philippines, the Enhanced Fiscal Regime for Large-Scale Metallic Mining Act, signed in September 2025, introduces a profit-based royalty system and a tiered windfall profits tax of 1 to 10%. Crucially, the law mandates ring fencing, which prevents the company from offsetting losses from one project against profits from another, potentially increasing the effective tax burden on the Masbate gold project. Financial and market risks. The company's financial profile is currently at the peak of a heavy capital expenditure cycle, which resulted in a negative free cash flow of approximately $248 million over the last 12 months. B2Gold also carries a $500 million gold prepayment obligation, requiring the delivery of physical gold ounces through mid-2026, which is classified as a current liability and constrains short-term working capital. Furthermore, with a beta of approximately 1.23, the stock remains highly sensitive to fluctuations in the global gold price, which directly impacts its ability to fund future growth projects like Gramalote in Colombia. Conclusion. B2Gold Corp is a company that has navigated the complexities of the 2024-2025 mining landscape to emerge as a stronger and more diversified entity. The successful commissioning of the Goose mine in the Canadian Arctic is a transformative event that significantly de-risks the company's jurisdictional profile while providing a high-grade production anchor for the next decade. Simultaneously, the continued production at the Fekola complex, even in the face of a tightening regulatory regime in Mali, ensures that the company remains efficient and profitable. The management's disciplined approach to capital allocation, balancing development, exploration, and shareholder returns, has preserved a strong balance sheet and dividend. While the company faces ongoing operational risks associated with the Arctic ramp-up and geopolitical risks in West Africa, the undervaluation of the stock relative to its intrinsic cash flow potential offers a significant margin of safety. For investors seeking exposure to the gold sector, B2Gold provides a combination of high-margin production, a robust growth pipeline through the Gramalote project, and the potential for a major valuation re-rating as its geographic diversification strategy bears fruit. As the company transitions into its next phase of maturity in 2026, it remains well-positioned to capitalize on the sustained strength of the gold market and deliver value to its shareholders.